Hello, everybody. Good morning, good afternoon, good evening. I think it's good morning for most of us, certainly if you're in Europe. And welcome to our webinar on the ECB Strategy, the 2021 review and its future, the report recently released by the CEPR. We're having a discussion today. We're focusing on chapters 1 and 2 of the report if you have it to hand. If you don't, I suggest that you can download it. But don't be distracted now. We've got a great discussion coming up in the next 90 minutes. My name's Tim Phillips from the CEPR. I will be moderating today. What will I be moderating? Well, in a minute, Lucrezia Reichlin will be introducing the report and very briefly. And then we will be hearing from our panel. We have definitely an A-list panel today. Panel who are not authors of the report. They will be responding to what's in it, and it's very relevant for all of them. First of all, you will hear from Elga Bartsch, who is the head of macro research at BlackRock Investment Institute. Afterwards, Peter Praet from the University Libre Bruxelles, and Peter will then be followed by his successor as chief economist at the ECB, Philip Lane. So I'm very interested in what they have to say. We also have authors from the report, Klaus Adam from University of Mannheim, Michael McMahon, University of Oxford, Ricardo Reis, London School of Economics, and Beatrice, Weder Mauro. And they will also be responding to your questions. Really, the second half of this is all about what you want to ask the people who are on the webinar today. So please do that. You do that by using the Q&A tab that's at the bottom. Click on that, type in your question. When you go there, if you see another question that you like, upvote it, and it comes to the top of the list. I would recommend asking early, not late. If you hang on to ask your question, you're going to end up at the back of the queue, and there are always good questions that we don't have time to ask because we have a prompt finish today after 90 minutes. So seeing as we do have a prompt finish, I will get out of the way at the moment. First of all, I'll hand over to Beatrice Weder Mauro, president of the CEPR, among other things, who will briefly introduce the session. Beatrice, over to you.
Thank you very much, Tim. It's really a pleasure to see all of you on screen and even more people who we are not seeing who are now following us. It's a pleasure to introduce this second debate that we are having, feedback session, public feedback session and discussion about the report of CEPR on the ECB strategy and its future. This was a report that we started in parallel with the process at the ECB. And in fact, the ECB came out with its first announcement of the strategy a little bit before us. And therefore, we have had a very intense and very productive already back and forth between the ECB publicly and non-publicly. There was, of course, the big Sintra seminar of forum last week as well. And many of the questions that are being asked in the course of doing this strategy, but also right now, it couldn't be more exciting, I would say. You know, we have inflation is in everybody's mind, and central banks are once more in, I would call, exciting times. And of course, the question whether the strategy that has just been decided at the Fed and at the ECB, at how it fits into this possibly new post-pandemic world is absolutely relevant and will remain so. So one of the things that we have already decided is that this is not going to be the last CEPR report on the ECB strategy, but what we want to make this into something serial where we are as independent academics in the discourse and in the debate about monetary policy and its foundations going forward. So thanks a lot for everybody who, well, my colleagues and co-authors, but mostly also the people from the ECB, Phil, Peter, and Elga for being prepared to read our things and to respond to them. So I'll hand over to Lucrezia now.
Thank you, Beatrice. And Lucrezia, I'd like to introduce you so you can introduce the report.
Thank you very much, and good morning to everybody. As Beatrice said, this exercise has been sort of a parallel exercise to the ECB own review, so it should not be taken as a commentary, but an attempt to provide a framework to continue this discussion. A discussion that in any case is going on and has always been going on in the tradition of the ECB, which has always welcomed the interaction with the academic world. So the first thing that this report, the main message of the report is that, well, we actually welcome progress in the ECB strategy review, but also acknowledge that as it is natural, excuse me, some issues remain unanswered. So the strategy will continue to evolve. And it is good that the ECB, in fact, has announced that a revision of the strategy will be a regular exercise. So we aim at providing a clear framework for discussion of the current and future changes of the strategy. Today, we propose to focus the discussion on the first two chapters of the report, the definition of the target, of the price stability target as chapter 1, and the second chapter, which is the operational framework. Of course, questions are welcome on all other aspects of the report. We are here to have a broad discussion. Let me start with a short introduction on chapter 1, the inflation objective. So again, strong progress in our view has been made on the inflation objective. And we now have a single numerical value for the objective, 2%. We have symmetry around that value. We have a forceful policy reaction to these inflationary shocks. And then we have the willingness to tolerate temporary inflation overshoot or undershoot in bringing medium-term inflation back to target. So all this is welcome by us, it's good news. Now, there are a number, however, of unresolved issues that we discuss in the report. The first one is why 2%? Okay, so there is, an absence in the review of a discussion of the quantitative objective. So there is no analysis showing how the various structural forces, the zero lower bound, the low level of the equilibrium interest rate, the saving glut, whatever, justify the price stability objective pursued by the ECB. And, we are sure that this analysis could be provided in future releases, but, so far there isn't much. And in the report, we discuss how to address this issue and also how to communicate, to have a strategy of communicating eventual changes in the quantitative objective. The second unresolved issue is that while the ECB tolerates temporary inflation overshoots to bring the medium-term inflation back to target, it does not target such overshoots. So in other words, there is no make-up component in the new definition of the price stability objective at the ECB. So the make-up component means that it's a strategy that would seek to undo past inflation shortfalls, and this is not what is currently pursued. Now we acknowledge that it's difficult to communicate issues associated with make-up strategies. But we think that the absence of the make-up strategies would risk to undershoot on average the inflation objective. In particular, given the low value for the equilibrium interest rate, the value chosen for the objective, and the continued relevance on the zero lower bound in constraining monetary policy, there is a risk of undershooting, so to go below 2%. Now, it seems to be a little bit strange to talk about undershooting today, but we're talking about the medium term, not this temporary, possibly temporary, increase in inflation. Now, the third issue is that there is no clear discussion at the ECB how to discuss multiple objectives of monetary policy. So next to the primary objective of price stability, the ECB also cares, of course, about financial stability, about a balanced real economy, about climate change. But, there is really no discussion about trade-offs. I mean, actually, there seems to be like the implicit understanding that there are no trade-offs and that one could achieve price stability and all these other objectives without any cost, okay? But actually, we can think of a lot of examples in which there might be some trade-offs between, for example, full employment and inflation. This is something that may be relevant today, or even climate change and price stability, or financial stability and price stability, which is something which has been at the core of very heated policy debates. So to the extent that there is these trade-offs, how should we deal with them? And our idea is an idea which can be described as followed. The policy instruments that need to be used to achieve price stability may have cost or benefits in terms of secondary objectives. So the tools used to achieve price stability may either foster the achievement of secondary objectives or may hinder their attainment. And so when they help achieving secondary objectives, in our view, this justifies a more forceful deployment of the tools and therefore a shorter horizon for achieving the price stability. When instead the tools used to achieve price stability hinder the attainment of the secondary objectives, then this justifies less forceful deployment of these tools and then a longer time horizon. So we propose this framework related the cost of the instruments with the horizon, as a framework to deal with this possible trade-off. So this is basically my 5-minute summary of chapter 1. Let me get now to chapter 2, which is about the operational frameworks and the tools of the ECB. And let me just start with giving you the main basic message. So we think that, after more than 10 years of expanding the toolbox of monetary policy, what the ECB does in implementing monetary policy today is unrecognizable with respect to, pre-2008 crisis. So there is a new normal. And now there are many tools, and not just the short-term interest rate. There are outright purchases, long-term refinancing operations, negative interest rate, forward guidance. So all these tools should be considered a new norm, the new normal. And explaining what the new normal is, it's very important, and at least for 3 reasons. One is for credibility. So discussing, that what we are doing now is exceptional, but we will return to an old norm, really risk, the credibility of the policy if this continues to be, protracted. There is also a second reason, which is what you call norm setting. So the review sets the norm and provides a link to the treaties to which legal challenges and disputes to the ECB action can refer. So, it's important to explain what the norm is. And then effectiveness. So to the extent in which, the old days are unlikely to come back, then, we should, we should not describe this policy as temporary and we know that, if we do in a protracted way, this could, have an effect on the effectiveness of this policy. So we should discuss and acknowledge that, what is the norm. So that's our main point. Now, to the extent that we have to do that, then we have to be clear about what is the purpose and the mechanism through which these tools are effective for monetary policy. We make the point that the ensemble of this policy, they work both as substitute and complement of interest rate policy. And to the extent that they're also complement, they also should work not just at the zero lower bound, okay, not just when policy is constrained by the fact that interest rate is at zero. Now, the second point in the big picture is that we need a clear framework to communicate this variety of tools. So the world today is much more complicated than what used to be when we had just the short-term interest rate as a monetary policy tool. And we argue that the variety of policy use can all be translated in terms of their effect on the yield curve, the position and the slope of the yield curve. And we think that it's confusing today that these policies are sometimes communicated in terms of quantity, how much we buy, and sometimes in terms of interest rate, how much we affect interest rate. So we think that discussing a manual policy with explicit reference to the yield curve would provide a common denominator to this policy going long but stay focused on interest rate would help transparency and communication. On that, okay, as I said, we propose that the reference should be the risk-free OIS curve. However, we also stress that controlling the risk-free yield curve is not a sufficient condition to achieve the price stability objective, because it has to be recognized that there is no safe asset in the euro area, so there is no common yield curve for the ECB, and the existence of financial frictions, justify, they use, targeting in some cases also spreads in interest rate between countries, also because these spreads are correlated to, various financial market spreads. And we provide a discussion on what kind of indicator one could look at. We think that the market is currently struggling to understand the use of the term financing condition by the ECB, and we call for more transparency on these issues. Now, in the interest of time, I will stop here, but in the chapter, you will find a lot also of concrete proposals on some of these tools. We discussed the size of the balance sheet and what is the rationale about having a minimum size of the balance sheet to respond to the demand of reserves, to satiate the demand of reserves. We discussed the corridor versus the floor system, and we argued for a floor system. And then we discuss, we call for a clarification on the different interest rates that are used now at the ECB, and we call for a clarification on what should be the main rate for policy, and arguing for deposit rate. There are also, a longer discussion on the role of the ECB as a market maker, on the separation principle, on swap lines and clarification for the future availability of these swap lines, and limiting the use of emerging liquidity assistance, etc. So I will stop here. I'm sure that in the discussion, all these topics will emerge. Thank you very much.
Thanks very much, Lucrezia. I'm pretty sure that they will. So our format now is, first of all, we'll hear from our panelists. I think probably after we hear from the panelists, it would be good for any of our authors that are here today to, if they want to respond to anything, first of all, and that will still leave plenty of time for questions. But that means that now I'd like to hand over to Elga Bartsch. Elga.
Yes, thank you very much. And thank you to the authors and the ECB for providing so much food for thought. Because as the papers that accompanying the ECB strategy review, also the CEPR report, is a fascinating reading for central bank and ECB watchers, and does ask the right questions. And I very much agree with what was written in the report, and also, like the authors, applaud the ECB for overhauling its monetary policy framework. And in my view, the changes that the ECB is making are significant, and they stand a good chance to permanently loosen some of the previous constraints to deliver a supportive monetary policy stance to the euro area. And even though, I would also have to say that sort of even a full implementation of the new strategy, which might not be easy given the different ways on how to implement it on the Governing Council, the new framework might not completely get the euro area back to price stability. Now, the CEPR report was written in parallel to what the ECB's own review, so it doesn't really look at that question on whether this is enough. I think it almost gets us there, but I think there's also a crucial role to play for fiscal policy, and I'll come back to that even though it's not the focus of today's discussions. What the new framework does, I think, it likely rules out policy mistakes of the past that the ECB has made, such as the rate hikes of 2011, such as the relatively slow move to large-scale quantitative easing between 2014 and 2016 because of the complications of doing public sector debt purchases in the euro area. But it's also clear that with the new policy framework spelled out, ECB policy is now at a key juncture and does need to put that framework to work in full. We already saw a first installment, I think, with the change of the interest rate forward guidance, as Lucrezia just said, an important new instrument that has emerged in the last 10 years. That, I think, is already sort of putting some policy measures behind the commitment to be more persistent. But I think we also still need to see what this means for asset purchases, another new instrument that will remain in play for the considerable future. And I think that's where we now need to see that the ECB indeed is also becoming more forceful. So because at the end of the day, the overarching theme that we're all discussing here, and that also comes through in the report and in the introductory comments Lucrezia just made, is that the main concern for the ECB is still that inflation looks likely to be too low over the medium term. The concern is not the current sort of post-pandemic inflation spurt that we are seeing due to the uneven economic restart that we are sort of seeing unfold at the moment. And that, I think, for me means that at the end of the day, within the new policy framework, and it is for that to become fully credible, the ECB's own staff projections at some point in the future would need to show inflation projections moving above 2%, and not just because you mark to market your current numbers and maybe sort of the carryover into the next year, but really a tolerance to really sort of show that there is that tolerance on the back of one's own monetary policy measures, not external factors. So this is a meaningful step, but obviously more work is probably needed, and some clarifications here and there are also warranted. So let me turn to some of the conclusions from the report that I think we might want to discuss a bit further today. The first one is, I think there's almost uniform agreement that the move towards a symmetric inflation target is an important step, one that was overdue, and that sort of removes all the remaining confusion that there might have been. I'm less convinced than the authors, I think, about make-up strategies being the answer to persistently low inflation. And especially when I look at the experience of flexible average inflation targeting in the US, I really have some issues with that concept being quite hand-wavy. So I'm almost tempted to crack a joke about, does making it up mean making it up for past undershoots or for making it up, i.e. the strategy? Because what I see in the US at the moment is that the flexible average inflation targeting, which probably on all sort of reasonable look back windows is the Federal Reserve is there. They are trying to walk that back to some extent and are sort of very careful with their language around it. So I think in terms of more inflation tolerance, yes, that needs to be there. But I think we also should be aware that flexible average inflation targeting is quite stretchy in terms of a concept. And also what we need at the moment is more inflation tolerance because we're coming out of a low inflation environment. But if we really commit to it, then obviously after a potentially less transitory inflation overshoot that we are seeing post the pandemic, all of that overshoot also counts towards future monetary policy. And I'm not sure that that is really what we want, which is why I think that the ECB's framework, to me, with the explicit tolerance for inflation overshoot, if it's really sort of meant that way, could actually work more effectively because it addresses more clearly that one-sided nature of the problem that we are facing at the effective lower bound. But for that, we obviously need to see that tolerance. We need to see it in the own staff projections, and we need policy measures that are really more persistent and more forceful than they would have been otherwise. And like the authors, I think indeed we need to constantly reassess the numerical value of the inflation target and whether or not it allows for enough wiggle room for all the relative price changes that we need to see in the economy. And I would argue that this is particularly the case right now because we're coming out of the pandemic, a major shock that also is causing a disproportionate amount of relative price changes because a lot of structural shifts, technological transformations have materially accelerated in the course of the pandemic. And looking ahead, our efforts to tackle climate change will require even more relative price changes in the future. And so I do think that a regular assessment along the lines of the work that Klaus is doing is very necessary. But personally, my view would be that this should inform monetary policy decisions as to where the bias is, rather than tinkering with the official anchor of the inflation target on a regular basis. So very important work, I think, that is necessary, especially at the current juncture and looking forward, but not necessarily translating into changing that target all the time. I also fully agree with the decline in the natural rate of interest being the overarching issue that we're trying to solve. And I worry that the remaining policy space could even be eroded further in the future. But I'm not sure that this can be fixed within the operational framework of the ECB. Instead, I would be looking towards other policy areas such as fiscal policy, such as income inequality, or indeed the reasons that seem to be causing a disproportionate amount of risk aversion in financial markets and are weighing on equilibrium interest rates, not just in Europe, but also pushing the term premium into negative territory. And in my mind, what we have here is quite a fragile equilibrium in global government bond markets, and that especially in the view of the surge in debt and the rise in inflation. And some of the riskiness that is embedded in government bond markets is particularly pronounced in Europe because through the negative interest rates, we are having have eroded our coupon incomes much more quickly. And with government bond yields being so close to the effective lower bound, they also can no longer provide effective ballast in multi-asset portfolio if you have a major risk drawdown in risk assets. So I am maybe a little bit more radical, and would argue that yes, it's a problem that there is no safe asset in the euro area, a common safe asset, but make no mistake, there might not be that safe an asset fundamentally globally in government bond markets, and that's, I think, something that we need to discuss. And Ricardo in other circumstances has obviously worked on this. This brings me to an important topic, which is really about the fiscal policy, and I don't think we can leave it out, because in my mind, alongside the incomplete architecture that underpins the euro, the fiscal policy framework is the main reason that the ECB has not been able to restore price stability in the euro area since the global financial crisis. And this will need to be addressed primarily through fiscal policy reforms. Creating a fund through which the ECB could manage more sovereign bond purchases is not really going to fix this problem. And this is why, for me, the upcoming reforms of the Stability and Growth Pact are so important. Maybe we need another escape clause in the Stability and Growth Pact that pertains to price stability and the ECB at the effective lower bound. But I think we need to make sure that we get to the heart of the problem and not continue to rearrange the deck chairs on the Titanic, if you will, because if fiscal policy does not play an adequate part in stabilizing the euro area economy, monetary policy does not only get overburdened, eventually it will become ineffective in being able to stabilize the economy. And so the fiscal policy discussion is an important one, but I know it's not the focus today. I want to spend one last minute, though, also on climate change, because it comes back to this issue of the inflation target. I am super complimentary about all the work that the ECB, the CEPR, and many academics are doing to understand the macroeconomic consequences of climate change. But the transformation that lies ahead will bring material changes, and clearly monetary policy needs to understand them. But I think we need to be very careful about the starting point of that discussion, because it's not just the climate transition that will have material consequences for the outlook for price stability and financial stability, but it's also the climate damages that are likely to rise materially in coming decades, and potentially very materially if we don't take decisive action towards net zero. And at the moment, there is a lot of talk about so-called greenflation, and I know that Beatrice's work and shows that a lot of these fears are overblown. So pertains to the inflation pressures potentially caused by carbon pricing. But I think before we even go and look at the inflation implications of the climate transition, we need to acknowledge the existence of brownflation, i.e. the price pressures caused by climate damages. That's a reality in the same way that climate change is. And that brownflation is the correct baseline for any discussion, and making that the baseline changes the conversation and makes clear that an orderly climate transition is far easier to manage, not just from a monetary policy point of view, than a disorderly transition or insufficient measures that we're taking to fight climate change. And from a monetary policy point of view, I think it's really just for the discussion today, it comes back to the price stability target, and whether or not we can facilitate within the space that creates for the overall price level, whether we can facilitate all the relative price changes that we are trying to push through with the climate policies. Because, and then let me just conclude on one sort of overarching comment. I think going forward, monetary policy making will be a lot more challenged, not just because of the limited policy space, but also because conceptually what we're looking at with climate change and other things are supply shocks, and there's not a great deal that monetary policy can do about it. Instead, there is potentially an elevated risk for policy errors, such as premature tightening in the face of sort of temporary supply constraints caused by the pandemic. And there will be much more unfavorable trade-offs than in the past. And in the last 2 years, we have been talking a lot about the closer coordination between monetary and fiscal policy needed. And in particular in Europe, we have also gained the first-hand experience of fiscal and financial dominance during the Euro crisis. But I think in future, we might have to add climate dominance to our vocabulary, and we'll need to stress the interdependence of monetary, fiscal, and climate policies, and argue that that interdependence will need to be managed appropriately. So there's lots of very interesting stuff in the report itself. There's a lot more for future research that I just wanted to put out here. But thank you very much for putting together such an excellent piece of work and for hosting the discussion today.
Thanks very much, Elga. It is remarkable, isn't it, the number of words you can make by adding inflation to the end of another word. But yeah, thank you. And it's some excellent points that we will be dealing with later. But first of all, Peter, your response to the report.
Okay.
Yes.
So thank you. It's a parallel report. I think it's important to keep that in mind, because if the CEPR would have to rewrite the report, such a report, I think it would be somewhat different, drawing from all the occasional papers that have been published by the ECB, because there are a number of clarifications and discussions in the working paper. In a way, unfortunately, they came later, and I think CEPR would have benefited very much from that, actually. A number of responses are in some of these documents. Now, on the process, I think it's important to discuss that very briefly, because that's also part of the reputation of an institution, is being able to come with the review in a reasonable period of time. And also, it's a very inclusive process, which had happened. It's broad-based, and it drew from research. And I think this is to the credit of the ECB. And it's, I would say, much better than what I would have thought, much more open also. Then there is the discussion about the fact that it was unanimity, unanimous support. There is some trade-off between, do you want to have broad support, broad consensus, or do you want to have unanimity? I think it was very important to have unanimity. Of course, one of the criticism to that is that the hawks and the doves, if I may summarize, may be satisfied, but the market reaction actually was quite limited. And so all will be, the proof of the review will be in the implementation. And markets are still waiting for the test. And I think the test is coming now with the shocks, the supply shocks that we have now. And the effectiveness actually of the review will be tested, and is being tested probably now. It's starting to be tested now. Does it make really a difference compared to the previous practices? I think, and the review itself doesn't give you the answer. As I said before, you have unanimity, and that means also that everybody, the hawks and the doves, would agree. And it's a little bit like auberge espagnole, when everybody finds what he wants to find, but it lacks a little bit. Sometimes you have a little bit ambiguity on that. So the implementation will be key, and I think the test is coming now. So that's my first point. But overall, I think the process has been extremely well managed, much better than what I thought. And Philippe and your team, I think, have produced fantastic occasional paper that clarifies a number of points, so that that's to your credit and to the credit of the institution. The second point, I think, which is not dealt in the CEPR, well, partly in the CEPR report, but not in the ECB. The ECB basically take, the institutional framework as given. I think it's very important when we look at the ECB to think about the institutional framework of the monetary union. I think the monetary union is still incomplete, and it's very difficult, to judge a little bit the actions of the central bank without referring to the incompleteness of the framework. For example, if you look at the pre-global financial crisis situation, it is clear that there was a big deficit in institution. For example, we created later on the SSM, the ESM, and now we have the Recovery and Resolution Fund. I mean, all these institutional changes make big differences in the way, in the framework of the ECB. But the question I think that one should ask ourselves, and I lived through that sort of situation during 8 years, is that to what extent should the ECB give in, and make up, if I can say, for the institutional weaknesses. That has been very often discussions within the governing council when you say, we do whatever it takes to save the euro. Is that your task to do that? Is that among your objective? Or should you put, the responsibility to the Minister of Finance? And I think this question about the institutional framework is key. And to how far should the ECB be involved and maybe in its actions say, this is the responsibility of states, of government, and not having all the burden of adjustment, in stabilization policy. I think this is better understood now by the policymakers, by the broader, community of policymakers. But I mean, still the assessment of the environment is that we don't have a satisfactory private risk sharing environment, and we don't have a public sector risk sharing environment, which means that the burden on monetary policy is bigger in the absence of this, well-functioning framework. I think we should not forget that. And this is a continuously question within the governing council when you have to take decisions, is to say to what extent have you to make up, for the weaknesses of the environment, the institutional environment. I think the signal should be very strong from the ECB. I think they're doing that, but I think it should be very strong that you should progress in terms of banking union and private sector risk sharing, and also the other one, which is fiscal, but we don't discuss fiscal here. The third point, reading the CEPR report, that the environment of monetary policy before the global financial crisis was not that easy. So we should also not, think about two environments, the zero lower bound environment and what was before, the sort of comfort you had when you could lower the rates. I think it was not so easy. And the proof of that is that, monetary policy, was probably, not well designed in terms of, risk-taking behavior. And we had the global financial crisis. I mean, so I would say that many of these problems we had before the lower bound have been partly addressed with all the reforms in the regulatory reforms we had in the banking sector, but still the question about the financial dominance. Elga, you talked about climate dominance, but I say here the financial dominance question is still probably present, not so much from the banking sector, but probably from financial markets in general. So these questions we had before have been only partly addressed, and the central bank is still, whatever the question of lower bound or not lower bound, you are still in that sort of situation. My fourth point is now coming, really concretely on what Lucrezia has been saying on the objective of price stability. Yes, we had already before this issue about, the 2% in a context where you had, small but continuous supply side shocks in the economy. Think about the oil shock, because oil prices were increasing in the first 10 years of the monetary union, and that supported the HICP, but the core inflation was rather weak actually in all that period. The second element, which came a little bit later in the decade, was the positive supply shock related to digitalization already at that time, internet and all that. And I remember is extremely difficult, if you would add, demography and all other structural factors. And Elga rightly a very, very nice discussion, a presentation on climate-related relative price changes. I think this must be part of the discussion about the 2%. But it's extremely complicated to do. So I think the 2% is a sort of good sort of compromise. I don't see what could be done better. But as Elga was saying, you have to go deep into the discussion about, what these 2% are or more or less are the result of what. So you have to look at relative price changes and shocks and all these. So that's on the 2%. So I would dissent, about, should we have an objective that is a little bit below 2%, 1% or whatever. Some governors, had sympathy with that idea some years ago. Or should you go to 3 or 4%? I think this will not lead us very far. But understanding that, the driving forces behind the 2%, and especially the relative price changes that you may have in some circumstance, I think that's very important. It's very difficult to understand, what are the impact of demographic changes on underlying inflation. The third part is this question of secondary objectives. Are you still there? Because I don't get any feedback. Tim, are you there? Yeah, that's fine.
We're absolutely here, and we're listening to every word.
I never know. So the second, which I found fascinating in the discussion in the CEPR, I liked it very much, is a question about secondary objectives. They're really dealt with in the strategy review, but indirectly, actually, basically via the side effects and via, the discussion about proportionality. And I think, yes, CEPR is right. One should, address this issue directly and not via side effects, or proportionality reasons. So I will illustrate that with the two main points. The first is inflation, quid about, growth and employment. Basically, and this has not been so much, I think, Lucrezia, in your presentation, is the concept of medium term. We always struggled, about what is the medium term. And our view, which is still, I think, the basic foundation, is that for demand shock, you get, complementarity in the objectives. So primary and secondary objectives, would be fulfilled by your policy when you have demand shock. When you have supply shocks, of course, you have trade-offs. And basically, the idea is quite simple, and I think it's still there. I mean, it's when inflation expectations are solidly anchored. I know there is a discussion on that, but I think it's true. I mean, if you don't have inflation expectations problems, so they're solidly anchored, then you look through the supply shock. But then there are many questions. If the supply shock are lasting shocks and relatively mild, but accumulate over time, what do? It's a very difficult answer, very difficult to write it down. So normally you look through, of course, and you see the discussion today with the relative price shocks that we have today, which lead, to a headline inflation, which is high, but we think temporarily. But how do you deal with your communication and the policy if these are lasting shocks? Because they may impact at some point on inflation expectations. So I think this is extremely difficult point, but I agree that communication is improved and should be improved further. The other point is on financial stability. I was very satisfied because it's something I wanted since years and years, without success, to include financial stability consideration in monetary policy deliberation. Now, this is now accepted. I think one of the reasons why we, Governing Council, didn't want to do that was that it would be very difficult, to come to a solid conclusion in our deliberation if you include, longer-term financial stability consideration. Too much risk-taking behavior that may materialize, 10 years from now, 5 years from now. Very difficult to know. So basically, the conclusion was not to overburden the Governing Council with, consideration about financial stability. I think we could have done that more than we did in the past. Now I think it's very good to have it explicitly so that the second pillar now becomes a sort of financial stability pillar. And then when I look at the review, the outcome of the review, basically, and this for me was one of the biggest surprise, basically financial stability, the accent is very much put in the review on the transmission mechanism, things which are relatively short-term in terms of financial stability. So that would allow the Governing Council to discuss explicitly questions like non-linear, adverse, feedback loops, and question of sudden spread widenings, public, sector, but also private sector spreads. And so in terms of in transmission of monetary policy, as we know, this has been done very successfully with the PEP. Now you see that this is part of the framework now. It's looking at the transmission mechanism. Now, of course, the central bank doesn't go as far as what is being described in the PEP, which is basically to say that the ECB wants to ensure proper transmission, but that means that the accommodative monetary policy would be transmitted to all jurisdictions, to each jurisdictions, which is something which I never thought the ECB would come. But of course, it's in the framework of the PEP, and we are going to see later on, how this consideration will be included in monetary policy deliberation. But this is with the PEP, this is a precedent, and the strategy review puts the accent on transmission of monetary policy across sector, but also across jurisdictions. I think this is, for me, one of the most important points of the review, but we will have to see the implementation, which is not easy, I fully admit that. In financial stability, the other problem is the longer term, of course, because when you say, for example, as suggested in the CEPR document, that, when there are side effects, you may be persistent. The question about persistence and acting forcefully reminds me the discussion in public finances about, the shock therapy versus, a sort of smoother, correction of fiscal imbalances. I don't know, frankly. I don't know. It's very difficult to tell, because when you say, I need a persistent policy, so I need low rates for a very long period of time, it influences, because if I don't do that, there may be shocks in the economy if I change too quickly. But it's very difficult to know what are the longer term consequences of stretching the horizon of a policy. So I think it should be flexible. I think it should be communicated, but I think flexibility is key. It's very difficult to put a rule as suggested in the CEPR, because it really depends. But I think we need a very deep discussion about this question about the horizon and the side effects, because the side effects, you may say, if I act too quickly, then there may be negative side effects in the short term. But I go in the other way, which is I will be persistent, just low rates for a very long period of time. There are also side effects, and the question of horizon becomes very, very difficult to do. The question about the, almost finished, the question about financing condition or financial conditions, which have presently become a sort of intermediate objective of monetary policy. I think the CEPR, but I think it's also the practice. Philip, you will speak about this, I'm sure. It's looking at the OIS curve. I personally always did that, even with my hands. When I say the OIS curve goes, up and down and things like this, this is really as a sort of intermediate objective, I would say, because we think you change your monetary policy instruments, this impact financial conditions, or even broader, financing conditions, credit conditions, and all that, and that has an impact on growth and then on inflation. That's basically a very simple transmission. I think what is new today in the communication that relates to my previous point is that one refers to the weighted average sovereign yield curve, not only on the OS curve, but on the average yield curve. And I think this is quite new also. And I think it's a key discussion for the future when the PEP will be finished, when you're out of the COVID crisis. How will the ECB Governing Council deal with situation where the spreads would be widening for a mix, of fundamental and non-fundamental reasons. And I think this is a key issue, which I think the ECB made a big step in the review by, signaling, its understanding of the problem. And the PEP is also saying, we act, on that basis. But still, for other situations that's still a big question mark. On the instrument, it's quite interesting because there is a divergence between the CEPR and the review. In the review and the occasional paper, you find a lot of information about the efficiency of the instrument of QE, all complementarity, substitution. All this is not really new. I mean, we know that since many years. But here the question is always, what is the efficiency on inflation actually? And the CEPR finds that the impact on financial conditions is clear. The impact on inflation and growth is milder, if I can say, and milder than what the ECB finds in its own research. I don't know. I think the ECB is right here. I think the impact is big. Let me just say, I don't say it's a contradiction, but when the CEPR writes, for example, that coming late with QE was very costly, well, that means that QE is efficient, of course. So I think the answer to the efficiency is that the asset purchases are very much context related. Of course, when markets are dysfunctioning, QE is extremely powerful. When markets are functioning, it's basically a signaling function. And if you have a very credible forward guidance, which means, unanimity in the governing council, and you go in one direction very clearly, all together, then your QE is not so important. Of course, there is also the duration extraction and the risk rebalancing, but I think basically it's very much context related. And so for me, it's very difficult for studies because the samples are not very big in general to find, you can find both conclusions. It's both very efficient in some circumstances and lesser efficient in other circumstances. And so that's for the effectiveness. The very last point on the effectiveness, when you look at the ECB, they find indeed that it's very effective on growth and inflation. But at the same time, and this is an additional point, they say that there is still sufficiently room for market discipline, which is being expressed via spreads, and risk premia in general. And that's a little bit for me sometimes difficult to understand, because if you say I can influence financing conditions and lean against markets, market prices, which is the objective, is to have some control on financial prices. But on the other hand, you say that there is sufficiently room for market discipline. Where's the right balance between the two? It's a very controversial thing. And I think this is a fascinating discussion, because in one of the occasional paper on the efficiency of instruments, you find at one page, that it's very efficient to influence financing conditions. And later in the document, you see talking about proportionality and also moral hazard. You find that market discipline, there is room enough for market discipline. So it's not necessarily contradictory, but it's very difficult to see the balance between the two. And let me stop with this. Thank you.
Good, Peter. I was just about to wind you up there. So thank you very much. And we'll move swiftly on to Philip Lane for his response. Philip.
Okay, thank you. So first of all, let me thank the CEPR group. I thought it was an excellent report. And I would say, compared to what we put out, having a kind of compact report, which is very well written and which really captures a lot of the major points, it's much more digestible than I suppose, the huge material we put out in recent weeks. So as Beatrice said at the start, this has been a parallel report. But I would say, and Peter has already highlighted a little bit, is even since we came out with the governing council documents in July. So we had a 2-page strategy statement, and we also released simultaneously an overview note, which is I think around 18 pages, which was also basically a governing council document, which elaborates on different elements. But it's still essentially, trying to capture all of the different dimensions in 18 pages. It's still going to be fairly high level. So 2 weeks ago, we put out 18 occasional papers, and Peter referred to some of that material. And of course, the CEPR report was written and came out before these occasional papers came out. I would say the occasional papers, and you can see if you open these up, it's not just the ECB staff, it's been the whole Eurosystem at work. And you can see the very many individual named contributors who've put it together. And I think that that's a nice example, of course, made possible by the fact now in the online world, you can share analysis. It's much easier to have large teams working remotely, especially in a pandemic. So we have put out a lot of material, and I do think maybe some of the points, at the very least, you can see the material we were reading in forming our views, which is basically what's in the occasional papers. And so issues about the pros and cons of 2%, for example, as a target is covered. And let me say on that, I suppose in general, it's very important, and it's very important to me personally, that we have a coherent intellectual framework, a coherent academic framework, that we can engage with the professional economics community, the academic economics community. But I would say on top of that, we have an overlay. There's an overlay in all of the decisions a central bank is going to make, which is also about communications. So you might have the perfect strategy. It works perfectly in every model. But you might say, well, actually, for communication purposes, do we really want to formulate it like that, or do we want to adopt a different formulation, which captures the spirit of the intellectual first best, and substantively we think will deliver, but maybe it's not quite as elegant as some of the model-based solutions. So obviously, I'm trying to see what I can say here. I think there's many good comments here. So let me focus maybe on some of the issues. Behind all of this, so of course, saying we're going to target 2% inflation rate on a symmetric basis still leaves the question: how do you deliver that? So a lot of the strategies about how do you deliver that, and especially running throughout the whole review was the fact that we've had this trend decline globally in the equilibrium real rate. So then you have a lower bound issue, and you have to take it on. And this is why it was very important for us to be upfront and explicit about the fact that the lower bound shapes monetary policy, not only when you hit it or when you get close to it, but throughout the whole cycle. And that's so important, that your whole framework, if you act forcefully, so let's imagine you have 2% inflation, a negative shock comes along, having a forceful response so you don't drift down towards the lower bound could be a very effective response to that, for example. So here, the kind of issue about should we have gone for flexible average inflation targeting, which I suppose is kind of the most obvious pure makeup approach, or is there much difference in the end between that approach and what we've actually decided upon, which is essentially to commit to stabilize inflation at 2%, and in relation to the effective lower bound, to commit to using the range of instruments, asset purchases, rate forward guidance, refinancing, to mitigate the lower bound issue, and to be forceful or persistent in those policies in order to make sure we do stabilize inflation at 2%. And the only thing I would say here is it's very important to think about the initial conditions, because a lot of the models are timeless, saying, okay, let's imagine you're at 2%, and let's simulate how do you keep inflation at 2% on average. And if you have all of these negative shocks into lower bound. But we actually have an initial condition. We have a history, and we have a strategy that needs to take us from where we are now to stabilize inflation at 2%. So, I think the way I usually phrase it is what we've picked is in the same family of solutions as flexible average inflation targeting. And we have decided it's important to acknowledge you may have periods of moderate inflation, moderately above target for a temporary period of time. It's important for everyone to be clear about that. That if we have persistent policies, it may imply that. And then the question is, does it make a huge difference whether you have that by implication? If it's part of the transitory dynamics from these policies versus having a kind of strategic commitment to actually target inflation above 2 for a temporary period of time. And honestly, we've made the decision, the calculation that we don't think this is the pivotal issue. That the most pivotal issue is to pick persistent or forceful policies that will do enough to make sure inflation returns to 2 and it stabilizes at 2. It's very important, and Lucrezia brought it up, this issue about the norm. So I think the distinction here is, I'm pretty sure we don't say any of these policies necessarily are temporary. What we say are state contingent. So if these policies like asset purchases, rate forward guidance, refinancing operations are needed to overcome the lower bound, we will use them. So there's no time, it's not a time issue, it's a state contingent issue. These are to overcome the state of being constrained by the lower bound. But if the world changes, if R* goes up, if inflation goes up enough that we don't think we're constrained by the lower bound, it is important to have the hierarchy that, the hierarchy is that these are policies to overcome the lower bound. And therefore, if we're far enough away from the lower bound, we don't feel it's casting a shadow, then just using the traditional policy rates it is essentially, if you like, the norm. But it's a state contingent norm, not any kind of time dependent policy. I mean, so that's the way I would think about it. I think also in terms of the issue, I mean, I generally agree that I mean, we do, and Peter also confirmed it, we do typically model everything as running through financing conditions, where again, there's a hierarchy. You do have the OIS, the risk-free curve. You do look at the weighted sovereign yield curve. But just as a reminder, in a bank-based financial system, and given we know the history of the euro area, if you have the banking system under stress, which of course, with structural change, maybe it won't be like this in the future, you do have to keep an eye also on margins in bank funding costs, margins in lending rates, where TLTROs in particular play a role. So I think it's too reductive to say it's just a yield curve. And that's why we do honestly use the phrase of favorable financing conditions, because to stipulate ex ante that essentially all of these margins are stable and all you have to do is control the risk-free curve. Well, I mean, if that turns out to be the case, fine. But empirically, that's not been the case. I would say maybe going back over time, running through the whole thing has basically, what have we learned? What have we learned is financial crises have a big impact. They have a big impact on how the transmission mechanism, and we've learned a lot about the impact that has. So what this means also is, I'm going to slightly reorientate the kind of discussion about the monetary and financial analysis. I mean, Peter says it's essentially a financial stability pillar. I wouldn't frame it like that, because the transmission mechanism, it's very important that we are very good on this. I mean, the monetary analysis to me is super important these days. It's very, important because we also, when you have this package approach, calibration is really important. Working out exactly how to calibrate our policies. You have to study very closely all of the stages in the transmission mechanism. So, when we see, during this last year, tracking, okay, here, how are the TLTROs transmitting? How are the asset purchases transmitting? This is so important for basically policy calibration. So even if there were no financial stability issues at all, this is still really important work. It's also important for the feedback loop to macro. So again, regardless of the financial stability dimension, if you're trying to predict GDP performance and price setting and weight setting, I think there's a lot of evidence that the financial frictions do affect the traditional relations between GDP and inflation and so on. So the macro financial linkages, I think, are pretty extensive. Then the issue about trade-offs, financial stability, and as Peter picked it up, it comes in two ways. One is the medium-term horizon, and what the report says about using the kind of length of the medium term is clearly one margin. Peter also says this is always in the framework of managing these trade-offs, plus making sure inflation expectations are anchored, which is not a given, of course, given the history of the euro area. So that has to be in the mix. So then the question is, can we write a universal model where you can pick up all of these trade-offs? And this is where, I'm a big fan of modeling trade-offs, but I think where you run into limitations is there's not going to be a universal model. So we've got very interesting, of course, there's a long-running, long-standing set of models that captures the employment inflation trade-off in relation to supply shocks. And many macro models have that. There's now a new wave which tries to capture the trade-off that can arise between delivering the inflation target all the time and financial stability issues. So the work of Tobias Adrian, for example, there's a lot of very nice models trying to use the intertemporal dimension to manage that trade-off. But every one of these models basically captures one mechanism. I'm not seeing models, for example, where it does simultaneously a good job of capturing the employment inflation trade-off and the financial stability inflation trade-off. And this is why the proportionality analysis is so important. And where, by the way, I do think, and we are committing to communicating more about that. At any point where we make a big decision, or even if we don't make a big decision, we need to, on a regular basis, not just review privately, but also communicate. Here's our assessment of these side effects, these trade-offs. And of course, most importantly, if they influence our decision making. It's important also, but however, here is when we do have this package approach. Some of this can be mitigated through the selection of instruments and the design of instruments. So I think in some of the work we've put out, we're emphasizing, for example, that the tiering of the negative deposit rate may play a role. The fact that we exclude residential mortgages from TLTROs may play a role. Of course, all of those need to be studied. And also, we would always very much point to macroprudential policy as a way to mitigate potentially some of the intersections between low rates and financial stability. It's also important, I think, for us to be clear that quite often, and I think the occasional papers relating to financial stability are very strong about, they really, I think, nail the literature and make the point, well, sometimes what's necessary for price stability is actually supportive of financial stability. Sometimes there will be a trade-off, so that you don't have universal situations, and that's why I learn a lot from the modeling groups at the ECB and the Eurosystem and the outside world. But I do think it's always going to be, at a given point in time, we need to decide on the basis of everything in front of us what to do. Maybe the last point I'll make, I don't disagree, by the way, what the report says about the operational framework. but that was not really kind of at the front of the review. We were focusing more on targets and how to deliver the targets. But maybe just in terms of, the material in the review about trying to capture the impact of our different policies. Again, I think it came out probably maybe too late for the CEPR to look at, but let me advertise there's a working paper from June by a group of our monetary economists, which basically, I think does give, the latest up-to-date kind of assessment of how we think about the combined impact of negative rates for guidance and asset purchases. So for those listening, this is working paper number 2564 from June, Massimo Rostagno and his collection of quarters on that. So, I would invite the CEPR group maybe do they change their minds, or do they think they've learned anything from that paper compared to what they reported in the report? Okay, I know we're running low on time, so let me stop there.
Thanks very much, Philip. That's great. And yes, so what I would like to do is to get some response, especially from Klaus, Michael and Ricardo, because we haven't heard from you yet, on some of the issues raised there. The 2% target, financial stability has come up, trading off of multiple objectives, the framework within which these things are. Anything you want to pick up from that? Also, I note in questions, Richard Portes asked earlier about financial stability and why there isn't more of it in the CEPR review. Klaus, I'm going to give that one to you in a second. Looking at analytical framework questions, and there is also a question about climate, which I will give to Beatrice in a minute. We don't have much time, but Klaus, your response, particularly on financial stability.
Yes, thank you. So let me briefly talk about the 2%. So in the end, as Phil said, it depends on, are we going to achieve it or not? And the proof of the pudding is going to be in the eating. So our view on that was that the safest strategy to achieve it would be an average inflation targeting framework. Phil argued that what the ECB has actually chosen is close to that, and delineated some of the reasons of not moving there, including the initial conditions from which we started, several years of undershooting, which, if you start there, going forward would have perhaps meant, considerable overshooting going forward and amplifying inflation scares, and that's all understandable. That is a very difficult thing to communicate, but it is also true that at the time you start the average inflation targeting, you're free to pick as a policy institution the initial condition. And so I don't see how this is necessarily an issue. Elga mentioned that the way the Fed is making up the make-up strategy on the fly, and that's certainly true. And I don't think that makes a lot of sense what they're communicating. So a lot of Fed governors have been on the record saying 5-year back, 5-year forward, look at it, the forecast and what we've achieved, we're on average there. And of course, that approach to me doesn't make a lot of sense, because you can easily play ping pong. You have periods of undershooting, and then, it has been mentioned, going forwards overshooting, which would imply down the road for the further ahead horizon, further targeting. So this sort of arguments, are mysterious to me, how you can come up with them and make them serious. And that is, of course, a communication challenge in the average inflation target. Quickly on the financial stability issue, Richard Portes argued that, but it has also been discussed here in the panel. I think we do mention it in chapter 1, not only in the climate chapter, because we do potentially see trade-offs ahead. In particular between price stability and financial stability. I'm pretty sure this is something that is on the ECB's mind. And the strategy review as it is given doesn't provide much guidance on how we intend to resolve that potentially. I think macro-pru is not, resolving these issues entirely, because macro-pru is perhaps good for the private sector. But if, the instability issues are more elsewhere, then it is not going to be of much use, and someone will have to deal with that. Thank you.
Okay, thank you very much. Michael, can I come to you for your response, and then to you, Ricardo?
Sure, yeah, I'll just make 2 very quick points. The first one, I fully agree with the way Philip described, and I think it's actually very consistent with our chapter 1, the idea of having a coherent academic framework, but communication also being important. I think that's a really important point. I think that really fits in with the idea we have in the report of costly instruments. So one way you could sort of square that circle is to think about instruments as having different costs depending on the framework they're in. So, for instance, you might think a certain framework, it's easier to communicate even conventional policies in terms of what you're trying to achieve. Where I think there is a contradiction in that is then later when you came on to describe unconventional policies as state contingent, not time or sort of they're not now normal. And the contradiction there, I think, is that, I do think that unconventional policies are difficult to communicate. And so by remaining with the tag unconventional, having them sometimes in play, other times not in play, I think that raises the cost potentially, and it makes them harder to communicate, particularly when they're communicated in quantity-based ways, as opposed to, as the report sort of stresses, sort of putting them in a framework that's maybe always in terms of sort of yield curve percentage points, but the small point. The second point, and again, it wasn't what we were sort of put here to talk about, but I really want to endorse Elga's point about the importance of the chapter 3. I think the monetary fiscal interactions issue is a really big one, and I want to stress I'm saying this independent of my position on a fiscal council, but I do think the interplay between fiscal and monetary going forward is very important, and Peter actually mentioned it. There was a lot of talk of make-up strategies, but the idea of monetary policy having to make up for gaps in the institutional framework, and Peter was right, and I think it's the right central bank approach to sort of take fiscal policy as given. But maybe going forward, we do need a bit more coordination, and the report, I think, at least is the opening dialogue on ways in which that could be done in a coherent way in Europe. And I certainly encourage interested listeners to pick that up and take it forward. But I will, in the interest of time, I will stop there.
Can I just ask you to just clarify one thing? When you say a little bit more coordination when we're looking at fiscal monetary interaction, what are you thinking about?
Well, so the report particularly talks about the fact that we know that monetary policy, the effects of a given monetary policy are contingent on the sort of fiscal policy that goes with them. It is not to say that there is a complete coordination of, finance ministers meeting up with central bankers and exactly coordinating, but rather that there are people assessing, for instance, what is the environment. It's interesting, I bounce between the two environments. And in the fiscal environment, one of the things that you hear a lot now is, we can afford to do this because monetary policy is very accommodative. So each taking the other as given, there could be times where you run yourself into trouble. So just the report has a particular suggestion of a sort of committee to assess the current conditions between monetary and fiscal interactions, to at least provide inputs independently into both. That might be one way. It may not be the only way, but I think that discussion has to start, because the Maastricht Treaty has always taken as given complete separation, which is, I think, a little bit artificial and proving a little bit more difficult nowadays.
Thank you very much for that, Ricardo.
Great. So thank you so much. I'll also try to be very brief. I want to really emphasize something that, while noted by several people, sometimes can get a little lost in the discussion, but which was central to understand our report and how it interacts with the review. And that is that there were indeed parallel efforts. And what that meant, meaning we did not try to reply, otherwise we would have only been doing it now and releasing it in a few months, but rather how would the group within the CEPR that wrote this report would have thought of writing a mission review if it was charged with that task. In that sense, that's exactly the task the ECB had. And of course, the ECB covered many topics. And so there's a sense in which when sometimes mentioned, well, you guys mentioned this, but this was covered in the occasional papers, or was covered here, was covered there. Absolutely. In a sense, the ECB did such a good effort in including so many people that everything that we cover in some ways was surely covered by the ECB and so on. What the parallel effort implies, and we think is quite important, is that what we emphasize, what we think is important, what we focus on, ends up being somewhat different from what the ECB did. And we think that is useful for public debate as well as for economic debate around those topics. So when we in the report refer to the statement of the Governing Council and say, well, this was mentioned or not, In no way are we saying that this was not considered, studied, that the Eurosystem did not include it, and that this is not present in the occasional papers. We are instead highlighting some things that we thought were more important than, I think, by revealed preference or by statement the Governing Council did in terms of what it did in its 18-page report that Philip mentioned, or the 2-page report. And given that, look at our 3 chapters. Chapter 2, we thought we should emphasize the operational framework, even as Philip a little while ago said, well, our goal was more the target and the mandate, less so the operational, in terms of the emphasis, not that they didn't look at it. Well, we thought that was important for a reason that came up very clearly in Elga's intervention, as well as in Peter and Philip's, which is the trade-off between commitment and discretion and with communication or not. But we thought it was important to emphasize the operational framework, the new normal or the new norms, because we are worried that the fact that, one, the balance sheet seems to be the size of the balance sheet, what interest rate is being set, how are we trying to communicate or think about QE, is nowadays so state contingent to the point of being difficult to communicate and very much subject to the making it up as you go along, Elga's critique. And so that's why we thought that was important to clarify that. I think we emphasize that more. Likewise, when in chapter 3, which is almost entirely devoted to the monetary fiscal institutional arrangement, is again something that we think is quite important moving forward. And again, for reasons that have come up and that came up less in ECB, which is again, not to say that the ECB ignore these, but we think they should be highlighted more, even if certainly the ECB is constrained perhaps to think through its decisional framework. And then in chapter 4, when it comes to the climate, why did we decide to write that one and focus on that climate one? To show how to do this within, as was mentioned before, to think about secondary objectives or other objectives, in that beyond just stating one cares about climate change, one will do some things that imply, how would you actually think about trade-offs when, as we discuss in that chapter, when there's a certain shock that will push inflation a certain way, up in a certain way, should we think that, let's think about that outside of just demand versus supply shock boxes, but in terms of what this implies for inflation, what this implies for different monetary policy rules, how to think about that, where we were trying to illustrate how one can have a more, if not rules, at least transparency-based discussion of the trade-offs involved with having secondary objectives. So those are my comments, just to note that it's, I think in these emphases that I hope that we've contributed a little to the discussion. And in that way, not because we're doing something the ECB did not consider, absolutely ECB is full of wonderful economists who have considered a bit of everything, but what we emphasize, I think, really highlights what we think are some issues that are important and that we hope to contribute to the discussion. Thank you.
Thank you very much, Ricardo. Actually, Beatrice, just on the mention of the environmental policy, you started, so maybe we could wrap up with you, because I know chapter 4 does deal with that. We were concentrating on chapter 1 and 2. It's come up a lot of times today, which does really mean that now going forward, it is going to be at the heart of monetary policy, is it?
Well, it's definitely one of the things that monetary policy will have to take into account in the future, and the ECB is clearly ahead of the pack in recognizing this, both in terms of the macroeconomic work that is going on in order to understand these trade-offs that Ricardo was talking about. So our contribution here really is to have, apart from looking at the past and looking at what carbon taxes did in the past, run simulations. So that's also the answer to Anton's question. Yes, we have, what we do in the report, we run simulations of a large global multi-sector model, which looks at physical and transition risks separately under different scenarios of monetary policy rules. Now, I would want to one comment, just encourage you to look at that. But one comment that I think is very pertinent, and Elga, you have made this before, is that you've basically said, well, the physical climate risk is now no longer separate from the transition risk. It is the baseline, because we have, by all estimates, even if we are successful at COP, already quite a lot of physical climate risk in the bag. So we need to be dealing with that anyway, and everybody will have to be dealing with that. So yes, climate is going to, unfortunately, climate risk is going to stay very much with us.
Okay, thank you very much. It's not going to be chapter 4 next time, is it? It's going to be in chapter 1. So, thank you very much, everybody. We are right on time now. Thank you very much to everyone in the panel. So that would be Beatrice, Lucrezia, Elga, Peter, Philip, Klaus, Michael, and Ricardo. Thank you for all of you. Thank you for asking questions and for listening along. If you want some more of this, just let us know and we'll put it on for you. But we are at time now, as I say, so it just remains for me to say thank you to the panel, thank you to the audience, thanks to everyone behind the scenes at CEPR that helped put this on. We will see you soon, and goodbye.